All right, hello everyone. Thank you so much for joining us for our quarterly investment commentary webinar. I'm Margaret Sargent, Senior Marketing Associate at New Frontier, and I'm very pleased to be joined today by three members of our investment committee, Research Analysts John McCrary and Joy Zhang, and Chief Investment Officer Robert Michaud. Today's webinar will begin with Robert, who will discuss New Frontier's investment process and touch on how the investment committee has been navigating recent markets. Joy will then review the last quarter's performance for both New Frontier portfolios and the market overall, and John will be sharing insights from the quarterly market commentary. Then we'll have a few updates from marketing before wrapping up with a Q&A session. So just a quick note before we begin, your lines will be muted for the duration of the call to reduce background noise. So if you have any questions, please submit those using the chat feature of GoToWebinar. And without further ado, I will pass things over to Robert.
All right, thank you, Margaret. So as most of you know, we are a core portfolio manager, and our investment process has definitely the long-term investment objectives associated with it. But long-term, as you know, means that you cannot ignore what's going on right now in the short term. We often say that to be long-term optimal, you also must be short-term optimal. But if you're only focused on the short term, then you will not be long-term optimal. So I think 2020, if we can all pretty agree, has been quite a dynamic year. And so I think this is a good time to highlight the dynamic approach that we take to strategic asset management. We have for a long time said that we are strategic asset managers, but we're not static asset managers. Our investment process does adapt, and our portfolios change over time. It's not just about rebalancing once a year. So just to give you an overview of this, let's start with things that really all investors should be able to agree on. You may know we have a mathematical background around here, and mathematicians like to think about axioms to build upon. And so the axioms of investing are things that we should all think are solid foundations to build on. And pretty much we all should be able to agree that risk is important. You have to account for that when you're building portfolios. The correlations between asset classes matter, and then you need to find some way to balance the trade-off or optimize the trade-off between risk and return. And other things that are more, not always done, but definitely true, are that asset characteristics, risk and return and correlation between asset classes do change over time. Factor relationships change over time. And the future is uncertain, and you have to have some way of accounting for that. So how do you put this all together? Now, that's not so easy. So let's go through our investment process. So our investment process thinks about what are the right types of asset classes to invest in, what are the identifiable risk premia, diversifying assets. This is particularly important at times like this, when we don't know where growth is going to come from, and we don't know which part of the economy is most likely to be affected by events such as a pandemic. And then we need to estimate risk and return, build portfolios, and then monitor and rebalance our portfolios when necessary. So building capital markets. So this is a great example of, over the course of 2020, there has been, China has gone from being a very risky economy and asset class to one of the not particularly more risky than any other economy type of asset class. People who've seen tech stocks and growth stocks, things that are likely to continue to do well in this type of environment, as things that are much less risky than they had been before, and so demand for them has increased. Right, so it's undeniable that risk and return have adjusted, and that you need a capital market framework of adapting to that. And so we've had this framework that has taken into account not just historical information, not just economic theory to put some structure on it, but up-to-date market information, what the markets are telling us about risk and return of different asset classes right now. So certainly things like the yield curve and credit spreads are all very straightforward to measure and include in your investment process. And that has contributed to a lot of the dynamism of our portfolio strategies this year. The other thing is optimization matters. And so I think it's particularly important, again, to not just have a portfolio of stocks and bonds, but to actually have an optimized portfolio that allows you to take clever combinations of asset classes to maximize return and minimize risk, and really adapt to a changing market environment. And this is one way that even if you don't have superior information about the future, that you can just build a better constructed portfolio that's more resilient to different risks and will likely, on average, perform better over time. And certainly this is something that we have been experts in, and indeed is the reason why we founded the company, because we are experts in optimizing over uncertainty. We literally have been examining thousands of potential future scenarios in every time we build a portfolio. And this, of course, includes all sorts of things that you might not expect. We didn't explicitly have a pandemic scenario in our portfolio, but the statistical procedure we used included events that might look in data something like this. And it's nice to have independent researchers, especially Nobel laureates with the credibility of Harry Markowitz, agree with your research. So the other thing that you want to do is you want to be paying attention to your portfolio on a daily basis. And I like to illustrate our rebalancing, which is something that we do every single day in our process. And we have our current portfolios that we optimize to when we build an efficient frontier. But then we watch and pay attention to the portfolio as prices change. And we also pay attention as the market environment changes and the whole definition of optimality has changed. And so both of these things have been happening in a dramatic way over the course of 2020. And so it's been critical that we've had our rebalancing and portfolio monitoring process to be able to monitor the changes on a daily basis. And this has kept the investment committee extremely busy in 2020. But it has been important that we have been able to maintain appropriate risk control through this environment and keep our investment process going during a pandemic. And so it has, how this has all played out is it has been a very intensive time here. We've had to keep up with very rapidly developing events. We've always had a process that monitored portfolios on a daily basis, but you have to really look at it on a daily basis. You have to really pay attention to the changes almost sometimes from day to day to make sure that the portfolios are still behaving the way that they should be, do still have the right risk exposures, and can still be considered optimal. We've had to be much faster during this time period. And in fact, we have, in the last 12 months, we have rebalanced 4 times, which many people, for standard strategic portfolios, which is unprecedented, and many people might want to know how that has played out. But I think it's important to consider that we've maintained our principles during all of this. It's important that we've stuck to our investment process. We've continued to adapt our investment process. Much of it already was dynamic, and so it was naturally adapted. But when structural changes do happen, like I've already given the example of China has sort of changed its structural character in terms of its relationship with the rest of the economy and its risk. These are parts of the investment process that you do have to be able to adapt. And so this is what the rebalancing looked like. At the beginning of the year, it was after a strong year of good market returns and stable economic growth. And then we rebalanced at the height of a pandemic. That wouldn't have been possible if we hadn't been investing in ETFs and been able to know how rely on their liquidity and our investment process to be able to trade actually in the March 20th, March 23rd, and that time period, well, the VIX was at a historical high. These rebalancings, that one in particular, but again, the late May, early June rebalances, dramatically benefited the performance of the portfolios. And I think this is a good segue to go to Joy, so that Joy can tell us exactly how these portfolios have performed. But it has certainly been an interesting time to be an asset manager. Thanks.
Great. Thank you, Robert, for the investment overview. Now let's move on to performance. As a pioneer investing with ETFs over 15 years, well, for 15 portfolios in 3 different strategies: global multi-asset standard portfolios, multi-asset tax-sensitive portfolios, and multi-asset income portfolios, as well as high net worth solutions. So last year, we launched the first ever 6 global indices, ranging from the most conservative 2080 index, NFGII, to the most aggressive All Equity Index, NFGEI. The global indices are constructed in exactly the same way as our global standard ETF strategies. The indices are calculated and verified by S&P Dow Jones. As people are familiar with this, that we like to start performance with the review of those indices, as they are the most transparent representatives of our investment process, provided in real time. And this is an example of our indices reacting to news in real time. On October 6th, markets were initially optimistic that a bipartisan plan for a second round of economic stimulus would be quickly passed. So when a presidential tweet at 2:48 in the afternoon announced that there would be no deal, markets reacted negatively. I'd like to note here that this is not political, but just a good example of surprise news. In stock markets, much comes down to expectations. We don't want to focus on the negative news, but it's well understood that markets react more strongly and quickly to negative news than positive news. Look at how 6 real-time indices reacted to this event. Right after the tweet, our global equity index dropped 1.48%, and our global institutional index and the GBI fell 0.68%. And yes, you can always check the index performance during the day anytime in your phone or by your smartwatch to capture this dynamic of the market. Despite of those surprises, market continued their upward momentum in the 3rd quarter, with all our indices reached all-time high on September 2nd, bringing the year-to-date return back to the positive territory, indicated by green bar for our indices and yellow for blended benchmark in the chart. New Frontier Global Institutional Index and the GBI with 60/40 stock bond ratio posted 4.2% for the year. Except for our aggressive index being pretty much in line with the benchmark, our indices outperformed the benchmarks for this quarter and for this year. Remarkably, our less aggressive index, like 40/60, has performed exceptionally well compared to the benchmark, as well as compared to 40/60 peers in the market. For this quarter, high yield exposure continued to add to relative return within our fixed income sleeves. For this year, broad overweight exposure to long duration treasuries, gold, and China greatly contributed to the outperformance. Overweight allocation to small cap, on the other hand, detracted from performance. What is something new here is that we also launched 2 new Frontier US indices last year, which are constructed with the same investment process and the same technology as our global indices, but are designed for US investors with dollar-denominated liabilities. 4 more US indices that target at 2080, 40/60, 75/25, 90/10 stock bond ratio will come soon. And as US markets continued to dominate the rest of the world in 2020, our US index powered higher for a new record in September. New Frontier US Institutional Index and the DBI posted 4.6% both for the quarter and for the year. New Frontier US Equity Index and the NFDEI was up 5.8% for the year. Now let's move on to our tax-sensitive portfolios. What we have here in the chart is our net of fee composite performance for this quarter and year to date. Tech sensitive in general have performed consistently in line with our standard portfolios, with great performance both in absolute terms and relative terms against their benchmarks. Drilling down, municipal bonds in general underperformed treasuries for the year, and despite of a rebound in the second quarter from March sell-off, which explains some of the difference in returns compared to standard portfolios for less aggressive profiles. And in terms of multi-asset income portfolios, looking at net of fee composite performance in the chart, high dividends were slowly recovering during the third quarter, but the scope of the bounce back from the March sell-off remains modest. So compared with numbers we saw earlier with tech-sensitive portfolios, multi-asset income portfolios did not see as dramatic rebound due to low exposure to growth stocks. In the relative terms, multi-asset income portfolios outperformed the benchmark by roughly 1% for the quarter and 2 to 4% for the year. Overweighting in long treasuries and preferreds contributed to the outperformance. Again, it's important to remember here that multi-asset income portfolios are constructed to be income-oriented, and it has been doing a good job in tracking its investment objective. Especially in this low interest rate environment, we are providing consistent and stable yield, which is around 4% here. So now let's take a look at our assets we invest in. First, on the fixed income side. It was a quiet quarter for bonds, with interest rates likely locked at low levels for extended period of time. From Q3 column on the left, we can see treasuries were flat for the quarter as yields were barely changed from the last quarter. The Federal Reserve's policy shift towards greater flexibility on inflation led to a weaker dollar that boosted the performance of international treasuries. US TIPS posted a strong quarter as investors hedged against the higher potential for inflation. Riskier bonds like high yield were leading the quarter as investors seeking out high yields. For the year, bonds are ahead of US equities. Gained 6%, which is more than what S&P and ACRI gained in 2020. So looking at the chart on the right, you would see high yield in the yellow line has made up most of the lost ground since March sell-off and was back where it started the year. Investment grade corporate bond experienced a stronger rebound supported by Fed's credit facility, bringing its year-to-date performance into green with the 7% gain. As people will refer to as risk of the environment from March continued to dominate, treasuries outperformed AG, with long duration treasuries being the best performing fixed income in 2020 due to the sharp decline in yields during the first quarter. And treasuries work as we expect a risk managed vehicle in our portfolio to hedge risks. And on the equity side, interestingly, you will see from the color scale of the chart on the left that sharp decline of Q1 is shown in red. Strong rebound of Q2 is in green and extended yet slowing recovery of Q3 in yellow. Gold is without any doubt the winner of 2020 so far. So in Q3, market continued advance higher until early September when valuation concerns drove a shift in performance between growth and value, but growth later regained its lead. Large cap continued to dominate small cap. US REITs underperformed during this quarter. And during the September sell-off, international equities generally held up better than US equities. So as we can see here, emerging markets outperformed the US for this quarter. Looking at the recovery curve on the right, China, indicated in green line, was the best performing region, both for the year and for the quarter. Emerging markets in Pacific were almost back where they started the year, while Europe lagged further, which is in gray line, still down 9% as measured by MSCI Europe ETF. So far the numbers has been encouraging during the course of recovery, but there's reasonable concern about the sustainable recovery along the path of uncertainty. So with that, I'm going to pass over to John, who is going to talk more in detail about market risks and perspectives. Thank you.
Thanks, Joy, for the excellent review of market performance. Shifting gears, I'll be discussing some of the key ideas covered in our third quarter commentary. So after briefly overviewing the quarter, I'm going to focus on discussing the massive and historically important changes happening in monetary and fiscal policy. In some ways, this was actually the least eventful quarter of 2020, despite all the market activity that Joy has highlighted. The stock rally continued until September, propelled by large cap growth stocks. Both the S&P and gold hit all-time highs this quarter, but there was a September correction in large cap tech stocks, which have been viewed as defensive safe havens during the pandemic. Despite all this activity, this was arguably a boring quarter by the wild standards of 2020. And as Joy alluded to, on the fixed income side, the Fed has really tamed the bond market, with the AG only returning 62 basis points in Q3. But on the real economy side, the data has been extremely encouraging. And as Joy also said, the unemployment rate fell to 8%, and US GDP is expected to contract by only 4% in 2020. However, investors continue to face several significant risks. First is the pandemic. The coming months may be sobering. As shown in the graph on the right, confirmed virus cases have been on the rise worldwide. US confirmed cases are rising, but they're still below July's levels. Second risk is the upcoming US election. Derivative markets indicate high levels of expected volatility through December. Third, a new stimulus package has not been agreed upon, calling the recovery into question. Fourth, China-US relations have deteriorated, and the Sino-American conflict could escalate further. Finally, two other risks have received less investor attention. First, the quarter's frequent hurricanes and forest fires highlight the increasingly destructive effects of climate change. The photo on the right shows a California forest fire in the Sierra Nevada mountains. Second, the pandemic and anti-racism protests revealed deep socioeconomic inequalities that may harm economic growth. The commentary discusses each of these risks in more detail. In a major policy change that will be with us for years, the Fed announced a new monetary policy framework in late August. The new framework involves average inflation targeting, meaning the Fed will still use a 2% target for inflation, but it will tolerate moderately higher inflation until full employment is achieved. Since 1979, when Paul Volcker took over as Fed chair, full employment has been a secondary concern. The Time magazine cover on the right shows Volcker in late 1979, when inflation was 13%. The new policy framework means the Fed will no longer strictly prioritize low inflation over full employment. The world economy has changed considerably since 1979, so it makes sense to rewrite Volcker's rulebook, which we have largely followed for the last 40 years. And this next slide helps show how significant this new framework is. This is a plot of US inflation and unemployment from 1970 to 2019. The green curve is inflation and the white one is unemployment. As everybody knows, inflation and unemployment were both very high for much of the 1970s. So Volcker's rulebook was written within a very different macroeconomic environment. Volcker made it his mission to quell inflation. So he raised the federal funds rate to double digits, reaching a record of 22% in July 1981. Today's rate is just roughly 10 basis points, which is 200 times lower. So the market environment then was radically different from today's. By hiking rates, Volcker triggered a short recession. Inflation fell to 4% in 1982, but unemployment hit 11% that year. These actions are simply unimaginable under the Fed's new framework. Yet Volcker's approach was designed for a different world. But his approach was largely successful. His legacy of maintaining low inflation regardless of the unemployment rate lived on for decades. This approach helped usher in decades of fairly stable growth and tolerable unemployment. After 1990, inflation has exceeded 4% just once, but since 2010, inflation has often been below its 2% target, and this helped motivate the new monetary policy framework. Overall, it's clear that today's world is very different from Volcker's. Unemployment's 8%, and a pandemic is constraining economic activity. So adopting average inflation targeting is very welcome. The Fed has committed to keeping interest rates near zero through 2023. Because the Fed is willing to keep rates low to boost employment, the new framework raises the possibility of low yields for years. Nevertheless, investment-grade bonds remain necessary for risk management. High-yield bonds and gold are volatile, so they're not appropriate substitutes for investment-grade bonds. Prospects for inflation are uncertain. In the near term, high inflation looks unlikely. A few economists have argued that increased production costs will raise prices significantly despite consumer demand being weak. Yet most economists think inflation will stay low for the next few years. The long-term prospects for inflation are less clear. The Fed will attempt to push inflation above 2%, perhaps even next year, but this is far from guaranteed. Japan has undershot its inflation target for decades. Nonetheless, the Fed's new framework raises the possibility that inflation could spike in the future. To wrap up this discussion on inflation and unemployment, I want to show you a fascinating graph published by The Economist showing two so-called Phillips curves. As many of you probably know, according to traditional economic theory, inflation and unemployment are inversely related, at least in the short run. The idea is simple. When unemployment is high, income and spending are low, which depresses prices. On the flip side, low unemployment should put upward pressure on prices. It's important to be aware that this relationship has broken down over the last decade. The Phillips curve has been flat. The graph shows two Phillips curves. The blue dots and trend line show the curve for 2000 through 2009, and the red shows 2010 through 2019. The blue line is clearly downward sloping, showing an inverse relationship between inflation and unemployment over 2000 to 2009. In contrast, the red line, which shows 2010 to 2019, is fairly flat, indicating a fairly weak relationship between unemployment and inflation. I should note, though, that the Phillips curve has been flat at least once before in the 1970s in the wake of the oil shocks, but this helped motivate Volcker's approach. However, a flat Phillips curve is simply not normal. And this flat curve suggests that policies promoting employment have had little effect on inflation over the last decade. If the Phillips curve remains flat going forward, then the Fed will truly struggle to boost inflation. This means bond yields will likely stay low. The economic data improved significantly this quarter. Retail spending has increased for 4 straight months, and unemployment fell from 11% in June to 8% in September. Nonetheless, the economic recovery is at risk. Much of the surplus retail spending can be explained by high savings rates in the spring. And permanent job losses have steadily increased, rising from 2.9 million in June to 3.8 million in September. Recent layoff and furlough announcements from airlines and banks raise the possibility of layoffs increasing in the fourth quarter. Moreover, unless there's a federal extension, millions will no longer be eligible for unemployment benefits by January. Targeted stimulus is therefore justified on both economic and welfare grounds. On the other hand, if the US experiences a severe second wave, then another substantial stimulus package might be needed. Negative interest rates, yield curve control, and exotic monetary policy tools might be considered. Perhaps the US should conserve its fiscal and monetary firepower for this worst-case scenario. On the other hand, appetite for treasuries seems so strong that accumulating trillions more in debt could have few near-term consequences. The field of macroeconomics is undergoing a major rethink right now. The photo on the right is from a highly entertaining yet educational rap battle between John Maynard Keynes and Friedrich Hayek, two prominent 20th century economists. Although the video is fictional, it does raise several relevant issues. And we recommend watching this video later if you do have a minute. It's really fun. The video is essentially a debate over how governments should respond during a recession. Keynes argues for fiscal stimulus, while Hayek argues bailouts and government interventions are harmful in the long run. Their debate does fall flat, though, in one way. They're discussing recessions caused by normal economic behavior. For example, banks and businesses engaging in excessively risky behavior. But today's recession is essentially caused by a natural disaster. Restaurants and businesses that depend on in-person activity are not responsible for their collapsing revenue. However, the video raises a lot of issues being debated now by economists, many of them successors of Keynes and Hayek. Economists today are arguing over the impact of government debt. The orthodox view is that high debt will hamper investment and growth in the long run, yet recent evidence shows little sign of this. The effects of fiscal stimulus are also debated. Successors of Hayek think fiscal stimulus is usually counterproductive, while Keynesians think it is crucial. Economists have viewed central bank independence as essential for effective monetary policy. But recently, many central banks have faced increasing pressure from governments, and policy has not always been harmed, at least not clearly harmed. Finally, in many countries, politicians have struggled to pass adequate fiscal stimulus packages. This raises the question of whether unelected central bankers have a responsibility to stimulate the economy when governments cannot. There are several implications for investors here. Although the Fed has made its intentions clear through 2023, policy is less clear in the long run. Given that economists and policy experts are rethinking macroeconomics, there's uncertainty over what monetary and fiscal policy might look like in a decade. In short, Volcker's rulebook is still being rewritten. Additionally, fiscal stimulus may become a permanent policy tool. An orthodox view is that monetary policy should be the cornerstone of economic policy, while fiscal policy should be in the back seat. But with interest rates near zero, monetary policy has limited tools. So fiscal stimulus may need to be used on a regular basis to support consumer demand if it remains subdued. Finally, investors should be prepared for persistently high government debts. The US government's debt will not be falling anytime soon, and fiscal stimulus packages would raise debt further. Before concluding, I want to say a few things about China, which has been the best performing major equity market this year, returning 16%. And other emerging markets have returned negative 11%, at least as of end of quarter, based on the MSCI indices. China is the only G20 economy expected to expand in 2020, as shown in the table on the right. The OECD also forecasts an 8% expansion in 2021, indicating China will likely remain a key driver of global growth. Economic performance has diverged around the world, and China has thrived despite deteriorations in US-China relations. A few main factors are responsible for China's success and other countries struggling. The obvious factors are a country's fiscal stimulus and its pandemic response. China largely defeated the virus by March, and the government is sponsoring big infrastructure projects. Sectoral composition is also important. Economies with sizable manufacturing sectors, such as China and South Korea, have generally recovered faster than service-dominated economies, for example, much of Europe. The exception, of course, is service economies with large tech sectors. China also has a big tech sector, so it benefited both from tech and manufacturing. Investors have become increasingly interested in mainland China A shares, which are becoming an institutional asset class. It's worth mentioning that New Frontier has a modest allocation to Chinese equities, A shares being a small proportion of this. There's several complexities to consider when investing in A shares, so bear with me, I'll try to be fairly brief. MSCI has a 20% inclusion factor for China, meaning that for its indices, 80% of investable A shares are effectively excluded due to perceived risks involved with A shares. The chart in the upper right shows the weights of the MSCI Emerging Markets Index as of December using the 20% inclusion factor. And the chart on the bottom shows the index if the inclusion factor was 100%. A shares would increase from being 4% of the Emerging Markets Index to being 17%. So the inclusion factor has a large impact on the content of emerging market index funds. Another complication is that the majority of A shares are not investable for non-Chinese citizens. So 100% inclusion would still understate the size of the market for Chinese citizens. In addition, China makes up 16% of the world economy. So there's a large disconnect between the size of China's economy and the size of its investable equity market. And finally, A shares have been less volatile over the last few years, but it is uncertain whether this lower volatility will continue. I know that was a mouthful or earful, but the upshot of all this is that investors have a lot to consider when deciding how much to allocate to China. To conclude, the real economy indeed has improved considerably, although the recovery remains fragile. We're still in the midst of a pandemic, and economists will be rewriting the macroeconomic rulebook over the next few years. So there is a fair degree of long-term policy uncertainty. It's notable, though, that the largest risks for markets today are exogenous to traditional financial and economic theory. And these risks include the pandemic, election risk, fiscal stimulus negotiations, China-US relations, climate change, and inequality. These risks have the potential to interact or collide with each other, disturbing capital markets. For example, President Trump being diagnosed with COVID-19 was a distressing illustration of the pandemic colliding with election risk. Investors should be prepared for the possibility that more collisions are on the horizon, although this is uncertain. In order to navigate these risks, we at New Frontier believe that maintaining an optimally risk-controlled portfolio is essential for long-term investors. With that, I'll hand it back to Margaret, who has a few marketing announcements. And then after that, there'll be a little bit of Q&A.
Great, thanks, John. So for my part, I want to start by reminding you of the dedicated team that's available to support your work. So David Schubach in the East and Jesse Andrews in the West are our folks in the still largely virtual field. But I know that they're very much looking forward to when they're able to meet with all of you in person again. And our national business consultant, Nick Lamb, is also available by phone or email to answer any questions that you might have and share resources and materials. Now, we always value the opportunity to hear from you, so I do want to take a quick poll so we can pull that up. How many of you have previously accessed Frontier Advisor? So you can select one of the responses on the screen to be counted. The poll is totally anonymous. It's nice for us to hear from you and learn a little bit about how you are engaging with our resources. So we'll leave this up for a couple of moments. Folks can get their responses in, and then I think we can probably close the poll. That's great. So it seems like a lot of you are already taking advantage of Frontier Advisor. That's what we'd love to hear. For those of you who are not yet using it, I would encourage you to take a look. We can close the poll results. Frontier Advisor, if anyone is unfamiliar, is really designed to be a one-stop advisor resource center. It includes performance analytics, downloadable materials, trade announcements, advisor tools, all geared towards supporting your practice. So you can find that at frontieradvisor.com, completely free to make an account. Please take advantage of it. And one upcoming feature that I want to highlight is the addition of a client-friendly section under the Resources tab. So this will house pieces on our process, philosophy, strategies, as well as fact sheets, notes from our investment committee, and third-party articles, all of which you can share with your clients. So I know this is something that a lot of you have been looking forward to, so keep an eye out because it will be launching very, very soon. Next, I want to highlight our indices, which Joy discussed, and which are independently calculated by S&P Dow Jones. Specifically, the New Frontier Benchmark Series, which is a subset of New Frontier indices that was created to define convenient benchmarks for performance measurement and long-term risk management. The benchmark series is comprised of our two equity indices, NFGEI and NFDEI, and our two institutional indices, NFGBI and NFDBI. In addition to these four, we also have our full family of global multi-asset indices and our family of US multi-asset indices. You can find more information on our indices on our website under the Indices tab, and they're also available in real time through S&P, Yahoo Finance, Bloomberg, as well as on your smartphone, smartwatch, tablet, other devices using a Stocks app, so you can access them on the go. And with that, I think we can open the floor up for some Q&A. It seems like the first couple of questions are related and kind of unsurprisingly have to do with the upcoming election. So I think, John, you touched on this a little bit in your section, but if you want to discuss a bit more, what will the election's impact be on the markets? Do you think we may have already seen some early signs? And do you expect to make any changes to the portfolios based on election-related volatility?
Yeah, that's an excellent question and something that we've given a lot of thought. So there is certainly volatility that's been priced into markets already, with derivative markets indicating high expected volatility through November. And this is shown in VIX futures and also in options markets. And given how much volatility is priced in, markets may calm quickly if the election goes smoothly. Yet, the impact of the election really depends on the outcome and whether it's drawn out or contested. And some bipartisan experts actually raise the possibility of there being widespread violence erupting if the election is contested. And this would obviously be very distressing. And we definitely hope violence does not erupt, but investors should be aware of the warning. And finally, the best thing for investors to do here, I think, is to maintain an appropriately risk-targeted portfolio. And beyond that, there's just a lot of waiting on how the election plays out. But it is, I don't know if I have a concise answer on any changes we might make, but I think Robert might have a more direct answer.
I certainly don't have a more direct answer, John, but I can tell you this is definitely something that we think about, definitely something that we're concerned with, and we try to prepare our portfolios for. This is part of being well diversified. This is part of looking at thousands of different scenarios when we construct our portfolios. And yeah, so markets expect a certain outcome, and if as we get closer to the election, they'll hopefully become more sure of that. One of my favorite places to go for anything uncertain about the future is a prediction market, and where you have people betting with their money, not with their feelings, on an outcome of a certain event. I predicted is probably one of the better ones of those now, if you want to see what they're saying right now. But I think that if there's things happen sort of as expected, then markets are pricing that in, and there's always a little discount for the unexpected, but they're not expecting anything like some of John's fears, and so that would obviously lead to the really negative scenarios that people are worried about. But there's always a question of, especially as a U.S. investor, what should you do? The U.S. has traditionally been a place where capital flies to during times of uncertainty and volatility, and even in the past when the U.S. was the source of the uncertainty and volatility. But you don't want to completely say that since it's happened every time in the past, it will continue. And so I think that's a lot of what we're trying to accomplish in terms of maintaining a good level of diversification and keeping the portfolios up to date. We can say we just looked at them, and right now they look like they're still on target.
Great, thank you. The next question is, does U.S. debt matter?
Yeah, that's also another very good question that we've been giving some thought. And in the short term, in the next couple of years, at least the evidence so far is saying that high levels of debt really don't matter much, which has been surprising to a lot of economists, and just given how low yields are across the Treasury yield curve. But in the long term, the effect of high debt is really unclear. Economists disagree, and I alluded to this a little bit in my discussion on Keynes versus Hayek. So an orthodox view is that high debt's going to increase borrowing costs, raise yields, raise inflation, and crowd out private investment. So the idea is that that debt's really just going to harm growth. But another view, which has gotten more of a hearing lately, is that we could sustain high debts indefinitely, at least in the US. Demographic change, aging world populations, just these facts mean that demand for government bonds will likely increase. So there will be some heavy pressure from demographics to keep yields down. So that means governments might be able to get away with high debts, or at least the US government, because we do have kind of a privileged status in terms of world bond markets. But this is something that's going to be, like, the topic of high debts is going to be debated amongst economists for years until we get a clear answer, if we ever do.
Yeah, accumulating debt is good if you need the spending more now than you do in the future. Of course, you never know if you're going to need it in the future, and that's a lot of the problem. And if you accumulate a lot of debt, then you limit what you can do in the future. But sometimes people do make the mistake of conflating sort of a personal finance perspective on debt with a sovereign nation's perspective on debt. It's very different when you can print money and you have a lot more options available to you. So the question is, sometimes debt matters, and right. But what we have seen is that markets have been shrugging off the accumulation of debt for over a decade.
Thanks, guys. So I just want to note for everyone, we have had a fair number of questions come in, so we may not get to all of them before the end of the session. If we don't get to your question, we will be following up with you after the call. Please don't think that we forgot about you. So the next question is, I noticed during Joy's presentation that New Frontier listed US ETF portfolios as part of the strategies available. Can you shed some light on how these strategies differ from your current offerings?
Sure. So what we do well is we look at asset classes. We come up with capital market expectations, understand the relationship between risk and return across all the liquid asset classes, and then we build a portfolio for a specific investment objective. And so a U.S. or a domestic investment objective is different from a global mandate. It might be that there's somebody who has their liabilities, right? If they plan on doing almost all of their consumption in a very US-centric way, that they might want to have less global exposure than the average metropolitan world traveler. So it could be it's really a portfolio. Same investment process, same thinking, same optimization and rebalancing technology, but for a investor with a little bit of a more domestic investment objective.
Great, thanks, Robert. I think the last question we have time for is going to be, what is the benchmark for your 60/40 portfolio?
Joy, do you want to answer that so that you get a...
Yeah, sure. Yeah, so for our standard and tax-sensitive 60/40, the blended benchmarks are 60% MSCI IMI index plus 40% FTSE 3-month T-bill. And I also want to add for our multi-asset income 60/40 portfolio, the blended benchmarks is Dow Jones Selected Dividend Index at 60% plus 40% AG. So that is our benchmark for all our 60/40 portfolios.
Great, thanks, Joy. So I think that is all that we have time for today. Like I said, if we didn't have time to get to your question, please know that we will follow up with you after the call. And thank you so much to our presenters, John, Joy, and Robert. And thank you to everyone who joined us on the call today. I hope you have a great rest of your day, and we will see you on the next webinar.
Thank you.